If you don't understand how to do top-down analysis correctly, you're basically giving money away to the market. Most traders try to use multiple timeframes to get better entries. But honestly, if you apply every concept from the higher timeframes straight to the lower ones, your chart just becomes a mess. The key is knowing how to do top-down analysis properly. In this video, I'm going to quickly break down what top-down analysis is, why it actually matters, and how you can use price action and smart money concepts from the higher timeframe all the way down to your entry timeframe. I'll even show you a real trade example step by step so you can follow the exact process. So if top-down analysis still feels confusing or you're not sure you're doing it right, stick with me. This is going to make things way easier. And of course, don't forget to hit the like button and drop your thoughts in the comments. So what exactly is top-down analysis? Simply put, it's a way of analyzing the market where you start from the bigger picture and then work your way down. You begin with higher timeframes like the weekly and daily to understand the overall direction and identify the most important levels. After that, you move down to lower timeframes such as the 4-hour, 1-hour, or 15-minute chart to get more detail and look for cleaner, more precise entries. Why is this approach so important? Because higher timeframes show you the real trend and the levels that truly matter. When you already know the bigger direction, dropping down to lower timeframes allows you to time your entries properly without trading against the main move of the market. In simple terms, top-down analysis helps you stay aligned with the market, avoid unnecessary losses, and trade with much more confidence. So when we talk about top-down analysis, we're really talking about starting with the big picture first. You check the weekly and daily charts to understand where the market is generally heading, then step down into timeframes like the 4-hour, 1-hour, or even 15 minutes to fine-tune your setup and plan a high-quality entry. Why does this matter so much? Because when you start your analysis from higher timeframes, you get a clear overall picture of where the market is heading and which levels actually matter. Then, when you move down to lower timeframes, you're not entering trades randomly. You're trading in the direction of the bigger move instead of fighting it. This alone cuts down a lot of bad decisions and helps you trade with much more confidence. For example, there are times when the 5-minute chart looks strongly bearish, and selling seems like the obvious move. But when you zoom out to the daily time frame, you might see that price is sitting at a major level where a reversal is very possible. If you ignore that bigger picture, you could end up selling right before the market turns. Another situation is when price is moving sideways on the 5-minute chart, and there's no clear direction. But once you check the 1-hour time frame and notice the overall trend is bullish, it makes a lot more sense to focus on buy setups instead of selling weak breakouts that are likely to fail. Sometimes the higher time frame only shows a potential reaction area and nothing is fully confirmed yet. In those cases, dropping down to a lower time frame helps refine the entry. Things like a break in structure, a shift in trend lines, or a fresh supply or demand zone forming can give that extra confirmation. The main idea is that using multiple time frames together helps you understand what's really happening behind the candles and gives you more precise entries. That said, this doesn't mean overcomplicating things by starting from the monthly chart or using every concept you know. The goal is to keep the process simple and clear so you stay consistent and don't get overwhelmed. So now let's jump into the chart. We're looking at gold on the weekly time frame. Whenever I'm on higher time frames, the first thing I do is mark out the higher high and the lower low. The reason for this is simple. I want to see where the major pools of liquidity are. At the moment, it's clear that there's strong sell-side liquidity sitting below this low, and above these highs we have buy-side liquidity. On top of that, we can see equal highs here, which tells me there's a large amount of buy-side liquidity stacked above these levels. Because of that, even before I drop down to lower timeframes, my focus is already drawn to the upside. This is why higher timeframes matter so much. They show you the longer-term draw on liquidity, which is where institutions and banks are paying attention. They're not making decisions based on the 5-minute chart. At its core, the algorithm is always drawn to two things: liquidity and inefficiencies. To keep things simple, anytime you see equal highs or equal lows on any time frame, that's a strong liquidity magnet. Most of the time, you want to trade in that direction unless the market clearly proves otherwise. To figure out where price is likely to go next, we need to understand what it has already done. If I'm expecting price to move higher and take the liquidity above these highs, then I want to study how price is being delivered from the higher time frame down into the lower ones. This helps me align with the algorithmic order flow. So let's take this step by step just using this weekly chart. One thing that stands out immediately is this fair value gap, formed between the low of this candle and the high of the next one. Price moved aggressively through this area, delivering only buy-side movement. That tells me this zone is inefficient, and we label it as a fair value gap. This gives me a clear higher timeframe area of interest before I even think about refining entries on lower timeframes. Now look closely at the clues price is giving us. Notice how the bodies of these candles are failing to close below the weekly fair value gap. That's another sign of weakness to the downside. When I put this together with algorithmic order flow, I can already see several hints suggesting that lower prices are being rejected. At the same time, if we look at market structure, the picture is very clear. These strong bullish candles tell us that the overall structure is bullish. So when you combine this fair value gap, the liquidity building above it, and the bullish trend, it increases my expectation that price is more likely to move higher and take the buy-side liquidity above those equal highs. With that higher timeframe context in mind, we can now drop down to a lower timeframe, and in this case, we'll use the daily chart. The daily timeframe helps us add more detail to the story. Again, the goal here is simple. We're looking for confirmation that price actually wants to move higher toward those equal highs. The first thing I want to identify on the daily chart is where price is currently trading within the dealing range. This dealing range runs from the swing low all the way up to the equal highs above. Once that range is defined, we can grade it using DRT. The dealing range high is the highest price within this entire move, and the dealing range low is the lowest price within it. The midpoint of this range is the fair value, or 50% DRT. Everything below the 50% level down to the dealing range low is considered discount pricing. Everything above the 50% level up to the dealing range high is considered premium pricing. The market constantly moves between premium and discount, and understanding where price is within this range gives us valuable context for what it's more likely to do next. All of this extra information helps us align our bias before we even think about execution. Price is currently trading in the discount zone, around the 25% DRT level, and it has managed to close back above it. This is one of the most important areas I pay attention to. Now look at what happened next. Price pushed lower into an extreme discount, but before doing that, it first took out a minor sell-side liquidity pool. This is considered minor sell-side because it sits inside the range, it's internal range liquidity, not external. Price swept those sell stops, cleared that liquidity, and at the same time rebalanced an inefficient area of price. We can see another clear imbalance here, formed between the low of one candle and the high of the next. That candle sequence shows only buy-side delivery, which makes this area inefficient. This is our daily fair value gap. Once again, notice where the candle bodies closed, above the 50% level of that daily FVG. This is another strong sign of downside weakness. So how do we read all of this? In order for smart money banks or institutions to execute large buy orders, they need liquidity. If they want to buy, they need sell orders on the other side. Those sell orders usually come from retail traders placing sell stops below relative equal lows. And that's exactly what happened here. Price swept those equal lows and cleared out that sell-side liquidity. At this point, I have several things aligned: bullish market structure, a higher timeframe liquidity draw, equal lows being taken, and a clear price delivery narrative from higher to lower timeframes. Now I can start getting more precise. The next step is to mark out the highest high and the lowest low over the most recent days. This helps me identify where the major liquidity pools are sitting. Above this recent high is where the major buy-side liquidity rests. And below this recent swing low, the lowest point in that period, is where the major sell-side liquidity is located. So once again, we have a higher time frame draw on liquidity coming from the weekly chart, with those equal highs sitting above price. Even though that's our main draw, since we're looking for more short-term trades, we can still use that higher timeframe liquidity as our bias while targeting levels on the lower timeframes. Now let's drop down one more step into the 4-hour timeframe. Doing a proper top-down analysis is important, but that alone isn't enough. We also need to find setups that actually offer a solid risk to reward. That part is crucial. On these lower timeframes, my focus shifts a bit. I'm looking for clear targets, a logical entry area, and a way to refine my stop loss. This is where the trade really starts coming together. Based on everything we've seen so far, the market appears to be in some form of a market maker buy model. But just as important as knowing where price is likely to go is understanding where it's unlikely to go. This is where I start stacking PDAs. PDAs act like stepping stones for the algorithm. They help price move from sell-side liquidity to buy-side liquidity, or from one inefficiency to the next. So let's look at what price has done here. First, on the 4-hour time frame, our CISD has been confirmed, and price has closed above it. That's an important signal. At the same time, we had a strong fair value gap on the downside that got violated and turned into an inverse FVG. Inside that FVG, price then created a new FVG. So now we have multiple, nested PDAs sitting in the same area, all supporting the idea that a potential long setup may be forming. That confluence matters. It's also important to note that inside the daily fair value gap, this black dotted line represents the midpoint, or the consequent encroachment. You can see how candle bodies keep reacting around that level and continue to fail to close below it. Once again, that's a clear sign of weakness to the downside. Let's drop one step further into the 1-hour time frame. Here, the first thing I want to do is mark the weekly opening price from Sunday and extend it forward. If I'm bullish and I expect higher prices during the week, and for the weekly range to close higher, then ideally I want to see price trade below the weekly open early in the week. The reason is simple. Early week retail traders tend to get excited and chase price, especially when it starts moving lower. We can see that the low was formed on Monday, and that low created liquidity in the form of equal lows. After that, price stayed in a consolidation phase, quietly building sell-side liquidity above the consolidation low. Now let's move forward in time and focus on what happens around Thursday's opening price. The key level I'm paying attention to here is the New York Midnight Open. If my bias is bullish, I want to see price trade below that opening price before expanding higher, and that's exactly what we see. Next, I want to look left and define the near-term dealing range. To do that, I check where the most recent high was taken and where the most recent low was taken before 12 a.m. New York time. We can see that price rated the high here and also swept the swing low down here. That gives us a clear dealing range high and dealing range low. At this point, the algorithm has a framework to operate within, a highest price, a lowest price, and a midpoint, along with the 75% and 25% DRT levels. If we're bullish, we want to be buyers at discount, which means we want to see price trade below the 50% DRT level. Interestingly, right below the 50% level, we have equal lows sitting there. On top of that, we also have a 1-hour fair value gap formed between this candle's low and this candle's high. This FVG sits inside a bullish structure where we have a clear low, a high, and then a higher low. That makes this area a bullish breaker. On top of all that, we also have a reclaimed fair value gap to the left, along with multiple layers of confluence coming together in the same zone. This is exactly the kind of alignment we look for when refining a high probability long setup. Here, we had multiple levels stacked together inside a discount zone relative to the dealing range. Plus, there was a minor sell-side liquidity pool below price after 12 a.m., marked by equal lows. I was watching my charts just before the New York session, so I placed a stop order at the low of the 1-hour and 15-minute fair value gap, adding a few pips for the spread. That's where price triggered me on this wick. My stop was set just below the dealing range low, giving a clear, defined risk. For the first target, I aimed to capture the buy-side liquidity on the 1-hour time frame, and price moved there beautifully. One key point when trading off higher time frames is that you can re-enter on retracements as price moves toward the main liquidity zone. Later, price ran higher again and then pulled back, leaving a buy-side imbalance. When price returned to this zone, it created a new fair value gap, another strong algorithmic signal. This FVG also aligned with the 25% DRT level, and there was an unmitigated order block, which gave me a perfect second entry. I placed my stop just below the 25% DRT level, and price subsequently pumped higher, sweeping the minor buy liquidity pool. As of now, price hasn't yet reached the equal highs, but it's still moving in that direction, respecting the higher timeframe bias and the liquidity roadmap. Hopefully, this gives you a clear picture of how layering multiple timeframes, fair value gaps, dealing ranges, and liquidity pools can help you plan precise entries, stops, and targets. Thanks for watching, and if you found this helpful, make sure to like, subscribe, and comment what you'd like to see next. I'll keep making these videos as long as it's adding value for you.